should we sit here and nod on this?
Yeah, right. Just tell everybody we'll be back in a little while.
Back in 20 minutes.
If you were live here right now, yeah.
Donna May is treating us right.
She is treating us right. She is treating us right. All right, it's hard to turn off Molly Hatchet Fort Worth disaster, but yeah. No, my fight of trying to figure out how to work with this. My skill level is just do it. Okay. All right. We're gonna see here.
What?
It's that bad, huh?
May have to give it an annual review at the second half.
Okay. All right. All right, well, good morning. Can you all hear me online? All right, very good. And you can see the screen that says Bootcamp. Can you all see that? All right, very good. Hey, I love it when your cameras are on. So today, I got a phone call yesterday. I want to make you all aware of this, right? If you aren't aware of this, right? There's a giant capital gain coming from the Clearbridge Small Cap Growth Fund. So you want to be aware of this. So if you have clients in this, right? We've been taking people out of this fund for years because it's been underperforming. Yes, but we still have some assets in it. So we need to have Audra try to figure out how to figure out who's got assets in it. All right, from my clientele, for your clientele, you got to figure that out. All right, so we can get people, if they're in non-qualified, they're gonna have a monster capital gain. Okay, so we want to let them be aware of that, and maybe you want to take proactive steps to move them out of that fund. Okay, so just an FYI, if you weren't aware of that, Clearbridge Small Cap Growth run by Aaron Green, major capital gain coming. All right, so you got to get them out of it. If you're going to do it, get them out of it before 12/11. If it's qualified, it's irrelevant, but you should have them out of it because it's an underperforming fund. But if it's non-qualified, big capital gain coming. Okay, so I wanted to share that with you. All right, now we'll get to again. Dennis Kowalski, butter my buns and call me a biscuit.
Must be the D entrance.
Hey, walk along,
Dennis, don't-
hop along, or whatever we want to call him, okay?
Oh.
You want to say that? That's your chair, Duncan. So all y'all on camera, Duncan, the guy that's on crutches, been on crutches since March. Thank you, God, that things are going in a good direction finally after a second operation. There's a cake sitting third operation. I knew that. Okay, I'm in finance. I need a calculator. So there's a cake sitting right here. So Duncan said, well, this looks like my chair, and sat down right in front of it. That's a smart man, okay? He's going to be successful in life. Okay, so y'all see about the capital gain. All right, let's go ahead. And I don't know. It's been soft close for years. Okay, so go ahead, Donna, go ahead. So non-qualified money, heads up. Okay? Yeah, no falling asleep on there. All right, so let's talk about the market, okay? A little craziness happening, a little bit, no big deal. I've got some really cool stuff I think that you're going to learn some things from. Welcome to new people. If it's your first time in our boot camp, hopefully you'll find some value in what we're going to cover today. So I put together articles and I use them right when I'm meeting with clients, because if I say something, whatever, but if they read it, it's got to be true, right? If everything that's on the internet is true, right? Yeah, right. Okay, but if they see something that backs up what we're saying, I think that makes more sense. So you got some reading coming today. I'm preparing you in advance. Okay, so this is an article that we just got our hands on. I'm just going to let you catch a highlight, and we'll talk about anything we want to in it. Okay. So it's great that they see it coming out of the Mag 7 and going among other sectors of the economy. That's way better than depending on one sector, okay? So they're very bullish about next year, okay? Another article just came out. Now, the reason this could be attractive, right, is obviously it was a pretty tumultuous day last week. Now, in the world of investments, it really wasn't tumultuous. The market's at 46, 47,000. 1,000 points is whatever. But the news sensationalizes the points, not the percentage. If the market goes down by 1,000, it's 2%. Nobody's gonna have a stroke at 2%, okay? But if they say 500 points or 1,000 points or dramatic downturn or whatever, people see that and they get all panicky right away. So this is what typically happens after Veterans Day. Strength, okay? Now, a couple of these, let's make sure this is not somebody about boot camp trying to reach me, okay? So I think I showed this in last month, but there's about 2 or 3 or 4 of them that are really attractive here. So the market performs well after that. Okay, 93% of the time it's positive. But if there's not a recession involved, 100% of the time, the market is positive, an average of 18%. So when people are asking questions, you know, about what's going to happen now, right? We just had elections again, and some elections took place, and that always makes people freak out. So having evidence on your side, being able to back the evidence with statistics, right? Our job is to be calm, cool, and collective, not like, oh my gosh, I wonder what's going to happen now. The market's going to go up over time. That's what's going to happen now. Okay, what's going to happen today? It's going to go up or down, but it's going to go up over time. Okay, I know I showed this in the past. Just want to let you sneak a peek at it again. This is just a series of 4 or 5 articles back to back that are really attractive. And they're covering that you don't want the market just to be in a straight bull every day, every year. That's not sustainable. That's unhealthy. Some corrections are good. Okay. Some downturns. And I got a couple of new things I just got this week that, okay, my grandfather would have said are going to knock your lookers out. Okay. I'm going to use these a lot. So one more, I know I showed this also, but this is also really great evidence. Okay. 100% of the time the market is positive in the following 12 months. That is not a guarantee, but 100% is a pretty good indication. Okay. So when people ask you questions about what's happening with the market, what's going to happen in the market, none of us know, and you never want to insinuate, I know what's going to happen. But based upon history, this is what I see happening. I'm using statistics and facts, not emotion, right? Always logic. Now, none of these guarantee anything. But again, right, I'm going to place my bet on what happens consistently, right? When Michael Jordan was in his heyday, just because he shot the ball at the end of the game and you were down by 1 didn't guarantee a win. But I liked the odds. I liked the odds. Yeah. It'd be okay. It'd be okay, right? If you were confident in that. Now let's switch gears. Let's talk about timing the market. Some old stuff, some new stuff, right? When we were in Wyoming on our elk hunt, I received a phone call from a client, longtime friend. So, I mean, he's got my cell phone because I don't give my cell phones out to clients, but this guy does. Longtime friend. His son was investing with us, decided to take his money out, and he's doing everything on his own. One of his sons, okay? And that son called his dad and said, Dad, better get out of the market. The market's going to crash. Everything's going to heck in a handbasket. Pull out, sit in, cash well. So he calls me in Wyoming. And I have a 47-minute conversation with this guy. He's a really good friend. We talked about a lot of other stuff too. He's coming to our house Tuesday night for a dinner review. Okay. Because, he's, well, can I just get out for now for a little while until things settle down? Right. And I'm teaching them, no, you don't want to do that. You don't want to do that. You don't want to do that. Okay. So I did some searching this week and found some newer stuff on market timing. Okay. Or timing the market. The first thing, you've seen this slide 1,000 times. 91.5% of a total rate of return over time is how the money is allocated. It's not when you got in or when you got out. So we have to stay confident. It doesn't make a difference what the market's doing today. That's irrelevant. It doesn't matter. It's today. Okay, nobody's investing for today. We're investing for long term. So don't let the 1.8% rattle you or allow it to rattle clients. Okay, so some things you haven't seen. Interesting. This is 1950 through 2024. You can see the bulls are blue, the bears are yellow. Look at the amount of time the market is in a bear market compared to a bull market. And through that time, the market average is 1103. All right. So can you put up with those yellow areas to get 11%, or do you got to be in the bank getting 5? Okay. The next page is crazy. Okay. So we'll read what it says here. According to the market, or avoiding market downturns means missing up. 78% of the market's best days occurred during a bear or during the first 2 months of a bull. 78%. Nobody is smart enough to know when the bottom is. I know you've been, when I say playing, I said an insult, it's a comment. It's not an insult. Do you know when the bottom's going to be? Nobody does. Nobody does. Warren Buffett doesn't know when the bottom is. He's smarter than all of us times 100. Okay. Nobody knows when the bottom is. So people getting in and out, the devastation, right? 50% of the best days are during bear markets. That's when people got out and sat on the sidelines waiting for things to clear up so I can get back in. All right. Another 28% during the first 2 months of a bull. I was in the business, many of you in the business in 2008, right? When it didn't seem possible the market could go any lower, but it kept going. At the end of 2008, it was kind of like, this is probably done, right? Nope. March of 2009 was coming. Okay, when it bottomed. Okay, nobody. So anybody that thought I'll just get out and then get back in at the right time, nobody could figure it out. And that was in our lifetime, probably in most of our lifetimes, it'll be the most dramatic market you'll ever see. So you and I, look at the statistic on the right. With over 7,500 trading days, if you missed the best 30, you lost money over the last 30 years. Nobody is smart enough to do that. Common sense. Another one I have for you that's a new one, okay? About market timing. Pretty eye-opening stuff. Okay, I'm going to let you read a little bit here. Staying in produced an 800% better rate of return. This next slide is amazing. Okay. 1957 through 2003. If you miss the best day each year, right? It's staggering. Your investment was $1,200. If you just stayed in, your investment was $12,000. The one best day every year from 57 through 23. there is zero chance that you're not gonna miss the best day sometimes. Okay? We just gotta teach people, don't pay attention to what's happening. Don't pay attention to the press. Don't let that stuff influence you. It's not worth it. Time tested, proven, stay in over time. You win. Further in the article. So if you look at those statistics, it's pretty mind-boggling. Okay? Of when the best days come, not when you're expecting. We've had other articles like this, but this one defines it even further. See what it says further. That last paragraph is crazy, right? The market is positive 87% of the time. 87%, all of us have bet in 87%, right? I guess it's a bad time to talk about betting with the NBA stuff going on. All right. Right? An average of 20 to 21% in the 12 months following a drawdown. Okay. The statistics are overwhelming. Don't let emotion change you. One last piece. So article after article appear to be teaching us the same thing. Hey, Mitch, I just had somebody call and talk to me yesterday and they mentioned your name. And they said how big you were gonna be in Primerica, and that's a true statement. Okay,
Well, I sure hope so. I got a lot of work to do, Kurt, to get there.
now, they were very complimentary of you. I wanted to share that with you, okay?
Well, thank you. I appreciate it.
Okay, now, we've also seen this one. Okay, this is, we've also seen this one, right? This is 04 through 23, investing at the market high on the left side, investing in the market low on the right side, right? The difference of the two, right, is like 1.06%. Wouldn't you think it would be a greater, or 1.04, whatever it is, right? Wouldn't you 1%? Wouldn't you think the absolute worst case scenario to the absolute best case scenario over that 20-year period, wouldn't you think it'd be more than a % difference? I mean, I would have thought it'd been a lot more. Market timing is 1.8% of the total return. Okay, we're not going to get hung up on that. And then this one is a little bit older, but it's from 2023, and it's also really attractive because we just came out of 2022, right, when everybody was having a meltdown. Reading class will be over pretty soon, okay? If you don't sell in the decline, you're likely going to be rewarded. Look at the statistics. Why does the average investor get a lower return than what the market offers? They're in and out because they're like emotional decisions. The market's going up. Oh, it's really good. Let's buy. It's the right time. Market goes down. Oh, I'm really panicky. I better sell. Well, if you sell low and buy high, it's not a good experience. Many years ago, when David Siegel first got with Primerica, he ran for a couple years in a row, he did these stories, right? Money Magazine, I think it's February every year. I haven't seen Money Magazine since Columbus sailed, so I don't even know it's in business yet, okay? But it was really popular. They showed the best funds from the year before every year. And over 50%, it was like 58 or something, I don't remember, over 50% of the time, if you were the best performer this year, you underperformed the following year. So people go, I've been investing in the market for years. I follow Money Magazine. I never make any money. That's because every year they get the article, they sell something and underperform, buy the best one. You're buying it at the peak. Next year they get the new article and go, oh crap, I'm in the wrong one. Over 50% of the time it underperformed, sell that, bought the best one. Not going to make money that way. One more piece for you. So you see a similar concept across all of these articles. Missing just a few of the really good days is devastating. And if anybody could figure that out, we'd all be richer than Elon Musk. Okay? I mean, you can't figure it out. Now, I say stuff here that I would not say on Bootcamp or on MPI, excuse me. Okay? I'm extremely anti-tactical. I just showed you a lot of evidence. Okay? Here's one more piece. So I just, my opinion, I'm gonna just put, Meg and I run our money, we put it in the market, we stay in the market. I don't try to time it, I don't try to figure it out. Seems like it's working. Great book talking about this, okay? Great book. So we gotta have our clients not be worried. Just keep on doing what you're doing. It's no big deal. Now, for people that are worried though, man, did you see the market the other day? It went down a whole bunch. Look at this article. Staggering. Okay. So going back to 1928, that's pretty good. That's a pretty good research. Okay. So the average year is 29 days where the market goes down more than 1%. That's normal. Okay. So yeah, pretty strong article. So it's like, whatever, this is not like new. It's not like it's never happened. There's every year from 29, through year to date 25 or 28, excuse me. So things like this, I believe you can calm investors down. Because when you see something like this, okay, it wasn't just the first time, it wasn't brand new, it wasn't, oh my gosh, like it's never happened before. I've showed you this, but I've updated the article, okay? People, I'm going to stop a second. People think, wow, if they see a little volatility, right? And I'm going to go back to 2007, 2009, right? Because 2022 or 2022 and things like that were no big deal. It really wasn't. Check out this from 2007 to 2009. This is what happened during this time frame. The worst downturn since the Great Depression. Now look what it would look like today. That would make people nervous.
Oh.
Okay, that would make people nervous. But look at what it says here. The market reversed course, right? And got 20% of its money back in 3 weeks. Well, if you were the person on the sideline trying to wait for the right time, you just missed 20% return. Okay. And then, 30% by midday, 60% by the end of the year. So helping people accept volatility is normal. Right? When we were just in Wyoming, I've got some clients out there. And I do it here. I remind people every year is not going to be great. We're prepared for downturns. Remember, 1 out of 4 is bad, blah, blah, blah. I'm going to go through that in the second half. We're going to remind people so they don't think, because what happens if the market's really strong for a while, they think it's always going to be good. I'm always going to make a lot of money. Nope, you're not going to. Everybody has downturns. You just have to live through the downturns. So if they don't know they're coming, it's hard for them to deal with it. But if you've been teaching them, this is normal. It's normal protocol. Usually what happens when the market is down, our clients call us and go, just intend to put more money in. Is this what you talked about? Yeah, that's it. This is it. Good time. So if we teach and train the clients, okay? Now, many of you have seen this. I just want it to be a good reminder. I know sometimes for you that plug into the boot camp, I worry that you're like, gosh, he says the same thing constantly. Kind of, yeah, I do. Okay. I want you to be able to just operate on total reflex. Not like, just a second. Not like that. Okay. Professional athletes, the premier professional athletes operate on total reflex. Because if you're an NFL quarterback and you're trying to think, you're counting the stuff, you're counting clouds in the sky laying on your back. You should have got rid of the ball or whatever, any sport, right? Baseball hitter, pitch is coming in. Okay, I gotta think, which one is that? Smack. Oh, it hit the glove. I didn't figure it out in time. It's total reflex. If you want to be a pro in Primerica, it needs to be total reflex. I can just function. I just answer the questions. That's what I want you to be. So I don't mean to bore and kill you all the time, but is it reflexive? Can you just do it? So I continually want to give you information to build confidence in what you're doing. So let's look. Okay. I'm sorry. So the market is high. People call you. Should I wait a while? Should I hold off before I put the money in? No. Okay. So let's look at some time frames. People that invested at the market high, 825 of 87, before the worst day in the history of the stock market. People invested. That would be the wrong time to put money in, right? If you look, right, the appreciation fund averages 949. This is net after fees. CDs averaged about 4 since then, right? If a person put 10 grand in, they've got 43,000 in the bank or 296,000 in the appreciation fund. Same time frame. And I use appreciation fund. I'm not using the top performing fund that is available. I'm using a good middle of the road average or just above average growth fund. It's just a solid performer. It's never the hot one. It's never the best one. It just keeps on plugging away. So people had invested at that time frame. If they rode out the storm, they were handsomely rewarded. Okay. Several $100,000 more money. That was the worst day in the history of the stock market. Advanced to 2000. Okay. In 2000, 3/4 of 2000 was the market peak before the worst 10-year period in the history of the stock market. I'm not picking like just rough days. I'm picking like wows. Okay. CDs since then have averaged about 3. Appreciations average 7.8. $10,000 is 20,000 in the bank, or excuse me, I can't read my eyes. I can't read it. Or 65,000. Thank you. 65,000 in the market. We just looked at the worst day of the market. We just looked before the worst 10 years in the history of the market. Let's look at 2007. The market high, 10/9/07, before the worst downturn since the Great Depression. That would, you put money in, it's like, oh my gosh, total meltdown, right? So CDs are averaging about 2.5% then. Appreciation's average 9, 10 grand's 15 in the bank, or 45,000 in the market. Let's look at 2020. Okay. So the market high, 2/19/20, before the fastest 10, 20, and 30% downturns in history. Okay. The CDs are average about 2 cents then. Appreciation's average 10.8. 10,000 is 11 in the bank, 16,000 in the market. And then how about the latest one? 2022. Okay. 1/12/22 is the market high before an 18% downturn. All right. So if you put the money in, then CDs have averaged 2 cents in, appreciation 6.7, 10,000 is 10.8 in the bank, 12,100 in the market. So I just showed you the most traumatic times in your lifetime. For some of you, it's a much shorter time frame. Okay.
Yeah.
The most traumatic times in your lifetime, and the market won, even if you invested at exactly the wrong time. The market still won. Okay. Market's going to win. It's like you're outside. You going to beat Mother Nature? No, Mother Nature's going to win. Okay. I know you wanted to plant today, but it's going to rain or whatever, right? Mother Nature wins. The market will win over time. You just got to deal with the bumps and bruises. Now, some of you have had the fortunate opportunity to invest money for people at exactly the wrong time. And this is when you truly earn your income, when you keep people in when everything went wrong. Okay. Example. A person gives you $100,000 on 10/9/2007, the market high. Okay. At 3/9/09, right? So not even 2 full years later, their 100 grand they gave you is worth $52,000. How's that client who's a first investor? How are they doing right now when they look at their account? Yeah, they're you know, they are thinking they invested with the most stupid person in the history of the world. Yeah, he was worse. Okay, he was worse. There's an interesting story there. Cost me a few million, that guy. Okay. Now, they are in complete meltdown. I need you to be able to function on complete reflex in times like this to deal with people. Okay. Because if this person gets out of the market, they just devastated their financial future. We've got to get them to stay in the market. So preparing them in advance that things go wrong sometimes, and that's just how it is. It's okay. You'll get through it. Preparing them like that is a big deal. But look what happened, okay? If they got out during that time frame and put their money in CDs, they got about 2.5% since then. So their 100,000 they put in that was down to 52 is back up to 77. Okay, that's at the end of 2024. If they stayed in the market, it was 100 grand 3 years later, if they stayed in the market. And today it's $466,000. So a calm, sound decision-making process saved this client from a $380,000 error. Our clientele cannot afford an error like that. I mean, how many of your clients can take a $380,000 error and still retire comfortably? I think very few, very few. Okay. Whoops. I was gonna take this one out. I had that in there too. Same slide. Okay, just the guy panicking. All right.
You gotta give that guy a name.
The guy on the ledge is Joe Average Client. Okay. Yeah, we use Bill a lot. No, nobody likes Bill. We don't want to use Bill, okay? So, oh. I kind of like that, but I'll leave it alone. Okay? All right, now. Okay, now. Staying calm and positive when your clients are panicking, you could save their financial life. You not being confident in what you're doing and not showing them confidence, they can make a decision to cost them for their financial life. Okay? We have got to have people, we've got to teach. We've got to be consistent. Okay. Yes, sir.
I just recently, actually during the 2020, I got somebody's, everything that they had for retirement during 2020. They put it all in managed account, or no, it wasn't a managed account yet. Anyway, it ended up dropping from 300, just under 300,000 down to 160.
Mm-hmm.
And this person is extremely conservative, always was very risk averse. They stayed in, and now it's just about 400. So I've seen it just in the last, since 2020, and that was someone that was very risk averse. You probably would.
Yes. So use that confidence when you're meeting with people, because it will happen again, and we're going to all face it again. Okay, let's do a client example. I got a couple of them for you here. Okay. So this is somebody that Isaac is working with. Okay. Their brother passed on. Okay. And the brother had the money with Dewey, Cheatham, and Howe. Okay. Which is this guy. That would be Benjamin. Okay. Now, Benjamin wants him to keep his money there, and of course, roll the money that his brother has with Isaac there also. So he's wanting him to buy a single premium fixed index deferred annuity. That would, of course, be much better than the managed account Isaac has him in. Okay. So let's learn a little bit about these. All right. The client is 66 years young. The first thing I want you to notice, Braden, what does that say up on there?
Upon annuitization, the contract has no cash value or death benefits, cannot be surrendered, and provides only periodic payments.
What does that mean from your viewpoint?
Seems pretty bad. That's what it sounds like.
Yep. It's not yours anymore. Whose money is it? It's the insurance companies. What are you entitled to? A monthly payment. You cannot change your mind. Okay. Things like this wear me out. At some point, I'll use my mother-in-law's example. Okay. But I'll give you a quick story to humor you, but let you also know, stay on track, stay confident with what you believe in. When my father-in-law, I never knew him. When he died, I will not mention company names, Lutheran Brotherhood. Okay. He was a Lutheran pastor. Yeah, it's now Thrivent. AAL and the Lutheran Brotherhood went together to become Thrivent, one real crook versus two pretty good crooks. Okay. Hide behind the Bible, screw people. Was that clear?
Color code.
Yeah, color coded more. So listen, we'll get on track here. Here's what happens. Two agents come to see my mother-in-law. She's living on Social Security. Okay. They take the death claim check, deliver it to her, sell her an immediate annuity, and take it home with them that day. When you just lost your spouse, are you in any position to make major decisions? Absolutely not. Okay. I recruit Meg into this business, and her mother, who's on the Lutheran board at a church in Alaska, her father, deceased, was a Lutheran pastor. Meg inkles to her mother about how bad AAL and Lutheran Brotherhood are. And of course, her mother's like having a cat. Who's this guy? Blah, 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 right? My mother-in-law, after years, because we recruited Meg's sister also, and both of them are ganging up on mom, like, Mom, you don't get it. Okay. Move their money to me, or first of all, they call Lutheran Brotherhood and they send an agent over to talk to my mother-in-law. Meg and Kathy are there as her daughters, which they are, but they're also life and securities licensed too. And Helen, my passed on dear sweet mother-in-law, says, I want to get more money out of my account. So the guy proceeds to wave a tail, and he finally tries to sell her a $200 a month whole life insurance policy so she can build cash up so she can take money out when she's older. Unbelievable. I have all the illustrations. I made a training out of it. Unbelievable. He leaves, and Helen, well, I don't think I heard her say dang even. Looks at Kathy and Meg and says, by gum, I guess Kurt's right. By gum was a pretty strong word. And that's what this guy is trying to get this guy to do, buy one of these. Now, I want you to notice a couple things. Beginning at age 100, just when you need it the most, you can start getting out $21,000 a year, or if they pay their non-guarantees, $110,000 a year at age 100. Okay, that's important because I'm going to need a lot of money at that point. They're guaranteeing him the 111 grand they put in. They're guaranteeing a 1.85% interest rate, and their projected return is 6.65 over that 34 years. Can anybody beat 6.65 over 34 years in the market? Like every person alive? Okay, how did they do that? Okay, this is the illustration. Half of the money is going in a one-year S&P 500 point-to-point program, and the other half is going into a fixed account guaranteed at 4.5%. Now, what does point-to-point mean? It means from like contract issue to 12 months later, because it's a one-year point-to-point. The participation rate is 60%. What does that mean? Yeah.
Well, if they start at 10 and a year later it's at 11, point, missed out on all that stuff in between. 60% of them, you're only gonna get 6%.
You get 60% of the S&P 500. Yep. Okay. So that's what the guy's proposing. All right. Well, let's look. Here is the half, the half of the money, the point to point. The most recent 10-year time period was 8.74%, although the S&P was 1309 during that time frame. Okay. The best 10-year period was 9.64, although the S&P was 17.55 during that time. And the worst year, look at this, it's supposed to be for protection. This is only the half that's the S&P this is only the half. The worst year was 6.65, and the S&P was 5.97. So it helped you 0.7% in the worst time, but it cost you gazillions in all the other times. This is only, go ahead, Kel.
So when they gave you like those annual returns, like in the middle,
Yep.
9.64, but would he only get 60% of
Yes,
that?
yes. Yeah. So that's how it comes up with the numbers. Yeah. Now, point to point, let's analyze this. Here is the last 10-year time period with the S&P. And here's what the 60% cap does for you. okay, in red. So some of these, when they sell, I put 2,500, that's irrelevant. It doesn't matter the returns that we're looking at. Some of these show that there is no, that you can't ever lose money. Any negative year is zero. That's not true in this one, because when you do the calculations, it's a higher rate of return than the chart shows. They're getting 60% of the downturn also, because the numbers match up when you calculate it out. So that's what the cap does. Now, here is your selected allocations. I'm sure he selected them. Your selected allocations, right? The most recent 10-year time period returned 6.81. That's half in the cap and half in the 4.5%. The best 10-year time period, you returned 7.3. You only missed 10% of the market. And here's what's interesting. The worst time frame, 5.62, the worst time frame performed worse than the S&P 500 did. So exactly what protection is this client getting with this product? They're getting nothing. They're getting nothing. Yeah, it's like, this is garbage. The client is getting exactly nothing out of the deal, except a nice commission check for the salesperson. Anytime you find these point-to-point things, some of them have, they aren't point-to-point, some of them just have like a monthly cap though, of like, let's say 1.5%. So you think, wow, that means I can get 18% a year. No. Okay. Look at the years. Okay. A 31 well, this is a bad example. I'm sorry. I'll do these another time. I've done them, but so you do the hypo, but you run it monthly. And you look at all the months where the 1.5% cap, where the market returned 2.5 or 3, no, you miss that. Okay. So I've seen those where the negative is 0. You can't go backwards. But you don't ever make any money, because most years you make money in 3 or 4 or 5 months. That's how most years work. The rest of the months are like whatever. But 3, 4, 5 months are when the money's made. Well, you're capped on those. So you think 1.5, well, I can get 18. You're not going to get 18. Okay.
So that example, they cap it 1.5% for the month, no matter what it did then.
That's correct.
Month, mine went up.
Yep.
Yeah,
Yeah.
a downturn
Yep.
like at the end of one month, and all of a sudden it shot up
Yep.
15% the next month.
Yep.
You lost out on something.
Exactly. That's not this one. That's a like, some of them show like a monthly cap. So I'm just like way negative on all these things, way, because I don't see value for the client. And I think this proves it more than anything. With your guarantee in your worst period, the market beat what you're asking the client to do. Might as well be in the market and get real money. Second client example. Okay. Second client example. We talk about these all the time, but they are becoming so popular. Like every 401k and their brother and sister, that's what they have, is target date funds. Okay. Giving good customer service to clients. Okay. This is an existing client. This is an existing client. Just double checking. I thought I saw his name, but it's not there. This is an existing client. Okay. Long-term existing client. Gonna retire on January 2nd. Okay. They've given great customer service for a lot of years. Okay. I've known about this, but it was like, okay. So he texted me this week, hey, when should I stop putting money in that plan? I'm going to roll over to you. Well, I said, you might as well finish the year, finish the year and do it. This is what he has. This is a Wisconsin deferred comp 457 plan. Okay. So a 457 plan is an optional plan that people can put money in, and there can be Roth and pre-tax options. They don't get a match. It's just an optional deferred comp plan. Okay.
There's always a Roth option.
Not always. Not always, but this one does. The Wisconsin one does. Okay, this is through Empower. Okay. So this is gonna be a really hard sale in December because he's already asking me when he can roll it over. Okay. Give great customer service to clients. Stuff like this is laying out there everywhere. But the point we want to talk about is target date funds. Okay. Last month or the month before, I went through a whole big thing and I'm just going to cover one article that I've used before. Target date funds aren't personalized to the client. It's a one size fits all approach. If you've done any research at all, you realize bonds are becoming worse and worse for clients over time. We're going to talk about some of that in the second half also. So they have lots of international exposure and lots of bond exposure. Even like a 2060 has got bond exposure in it. I mean, I'm retiring 35 years from now and they need bonds already. Okay. They change by the calendar, not by the economy. So they'll shift and adjust and sell stocks and get more into bonds as the client gets older. So in any of those examples I used, right? 87, 2002, 2008, 2020, any of those. If the client ages and the market is down, they're going to sell stocks and buy more bonds because that's what the age says they should do. That is not good for our clients to sell stocks in a downturn and buy bonds. Okay. You've all seen this article. Let you review it again. So not only have they lagged, they've done so without less volatility. So I want to take more risk and get a lower rate of return for sure. That's always a good plan. So you want to study and bone up on target date funds because like that's what all these retirement accounts are in. It protects the company because they've done their due diligence or 404C responsibilities with the with FINRA. But it's garbage for the clients. Okay, garbage for the clients. So this account's going into a managed account in January. Okay. All right. We're getting close to break here. Retail mutual funds. I've been getting asked for a long time about when are you going to update the retail mutual fund recommendations. The last one is 5 of 2024. The newest one is today. Right. I was dragging my feet because I was waiting for Putnam and Franklin to be able to interchange their funds without fees. Well, best case scenario is probably third quarter next year, it looks like. They're hitting some snags and it's not going smooth. It's not going well to try to integrate everything. Thank goodness we have them in managed accounts, but they're not here. So I did an update. Okay. This is the most recent update. You're going to see a couple of weird things on there. And in the second half, I'm going to talk more about this when we talk about managed accounts. But you're going to see things like the Franklin Defensive Growth Fund being used as a fixed income piece. You're going to see things like the Franklin Managed Income. These are portfolios I'm using as an income piece. When we develop portfolios, I don't pay that much attention to bonds. I'm sorry, that much attention to dividends. Total return is how we design all of our portfolios, retail and managed, and for the few annuities that we have. Total return. Okay, that's how we design them. I don't pay as much attention to the monthly dividend as I do total return. Okay? And I labored on this, Everswick and I talked a whole bunch of this week. And we're both in the same side that there's just not a lot of good happening in bonds. I don't know when a lot of good is even gonna happen in bonds. Okay? So you'll see that we went to the Franklin Income. I know he's jacked about that because I've never used it hardly. We went to the Franklin Income because it is a stock bond mixture. It does pay a really attractive dividend. Yes.
That's all that's been around like 75 years.
Yep. So I went to that as a fixed income piece, if you will. We are still using the short duration high income. It's really held well and done well. Terry's been a fan of that a long time. It's really held and done well. Paying a really attractive dividend too, although that's not key to me. But instead of using more bonds, I went to this defensive growth portfolio and this managed income portfolio. Minuscule differences between alpha, beta, Sharpe ratio, minuscule. I mean, minuscule. Again, he and I talked for a long time yesterday about this. There's hardly any change, but I like the upside better. So that's probably looks weird to you, but that's why I did it. The same reason in managed accounts, which we're going to talk about in the second half, why I switched from bond funds several years ago in managed accounts. And the results have been really, really good. So we're about to take a break. If there's anything we want to talk about for a couple minutes on the first half or anything on, a couple things point out on the bottom. Emergency fund choices, we're recommending the ultra short-term income fund, ARMZX, or the Franklin Government Money Market Fund. We are typically using ARMZX. Okay, money markets are just going to continue to be nothing. Okay, as interest rates go down. So we're using ARMZX. It's no fee in, no fee out, very attractive. Okay. We never want to diversify. If there's less than $2,000 and there's no PAC, I would never use more than one fund in an IRA. The reason I wouldn't do that is this. There's a custodial fee of $25 per account, not per fund holding, per account with IRAs and Roths. So if Isaac's got $1,800 in his account and I put him in two funds, at the end of the year, whichever one is bigger is going to get the $25 fee. So if you've got $1,000, $1,200, I don't want to cut that in half and have an account with $500, $600, $700 and get hit with a $25 fee. I want that to be in a chunk. It will have less impact on a. I know you may not think it makes a lot of difference. I'm looking at a client going, Dennis is going, I got this one account and half of it's never doing anything. That's because it keeps getting hit with a $25 fee every year and it's only $500. I want it to be in one fund so it doesn't look as painful.
You also have, I don't know if it's on regular accounts, maybe an all account. It's a single fund, 1,000.
Yeah, that's a different, yeah.
Small. Quarterly.
But there's 21 months for that to get to that. Okay, yeah. So how you beat that, if they don't want to pack, have Kelly put like a $50 pack on her grandson's birthday every year, an annual pack. Well, now it's a pack and you got 21 months to get there. That's how you beat that. Okay, but that's a non-qual. That's a different thing than this month, but yes, you're correct. Yeah. Okay.
Per fund.
Okay, yeah, per fund, per account, right. So is there anything we want to talk about first half or this before we take a 5-minute break? Yes. Good point. If you're setting up new IRAs or Roths for people and they're going to pack but not lump in, if there's money in the account on December 31st it's, or money period in the calendar year, it's gonna get a $25 custodial fee. So if Denny's gonna do a $25 a month pack to open an account, I can set it up now, but I'm not gonna start the pack until January. Because if he puts $25 in December, he's gonna get a $25 custodial fee. Now, if you're gonna put a chunk in, that's a different concept. But if you're doing 25, 50 bucks a month, I would probably wait, I would set it up, but have the January pack date start. Right, so we're not nicking him.
If he puts money in now,
Mhm.
he just put $50 in.
No, we're not gonna put any money in now.
Oh, you're not putting
No,
nothing in.
no money in now.
Opens the account,
Yeah.
but doesn't draw anything. till-
Yeah, if we're gonna put a chunk in, no problems. Yeah, if you're gonna put a bigger piece, and I got no issues with that, but, so is that okay, Mike? You see that, right? If you're only gonna do monthly pack, now if it's gonna be a bigger amount, I would tell the client, hey, Tim, you're gonna put $400 a month in. I want you to know there's a 25, I'd let Tim tell me now we're January, it's up to him. Okay? Any other questions before we take a break on the first half?
Can you hear individuals that are on the screen?
I'm sorry, say that again, please.
Can you hear individuals on the screen?
Yes, I can.
Oh, perfect, wonderful. This has been absolutely amazing, number one. My question is, when you have 1, 2, 3, 4, or 1, 2, 4, 6, 8 funds, what makes the difference between using one fund and 8?
How much money the client is working with, okay? If you're gonna do $50, I'm gonna probably do one fund. I could consider two. If I'm gonna make a mistake, Angel, I'm gonna over diversify versus under diversify. Right? Now, that could hurt performance of breath if I over diversify too much. But Edwards looked at this yesterday. I've been hearing you say this for 20 years, and now I say it, okay? You don't lose a client if you lag a little bit on the upside. You lose a client from dramatic down. So Franklin Dynatrek's got a great track record, but 2022 was -40. Okay? So if you have them only in Franklin Dynatek and they go through a -40 year, they could be gone. But if you had them in Dynatek and something else and they had a -28 year, right? You might be able to hold them. So I'm gonna over diversify versus under if I'm gonna make a mistake. Okay, that doesn't mean for $100 a month, I'm gonna do 4 funds for 25. I'm not doing that. So does that answer your question, ma'am?
Yes, thank you.
Any other questions for break? All right, we're gonna take 5 minutes and then we'll be right back.
What? I got that too, I was like.
I'm getting a little bit.
That's the guy that had me until-
Yes,
That's the company, that's the-
when I got here, I guess I'm happy.
Yeah, I'm gonna go buy some of your cake there.
Okay.
Yeah, like I said, got here early,
Thank you.
so I didn't have breakfast. I guess I had a cake for breakfast.
Did you go to La Crescent, get some cannabis seeds on it?
Charlotte. Oh, blah, 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 like that question in darkness.
Who's cake?
I made it, Kelly was over, and I'm like, oh, good, I'll make a bigger cake, but then you can have it. Didn't have to- After my breakfast. I don't know why I don't do that on our Saturdays, I should, cause I like to, but I don't want it at home. Here, I should.
I do. Very good, thank you.
Oh, very welcome, please shoot it up.
What are you studying for now?
65.
Wow.
I'll take that one on Tuesday.
Oh, it's like
Oh,
3
yeah.
days, I was gonna ask
Yeah.
if you took that yet.
Yeah. But 65 I take on Tuesday and yeah, I'm excited for it. Be good.
I'm excited for my call. How can I expect it?
So, I should get done about 12 maybe. I test at 8, yeah, so. Yeah,
Where you gotta do that?
Rochester. So, yeah, it'll be good. I got, they give you, well, like $3.5 for that, for those 65.
I went up there too.
Yeah, I still, yeah.
I went up there and took the test one time and we stopped at the gas station and we got this 5-hour energy.
Oh, yeah, yeah.
Yeah, the jitters, didn't you? And, lady says, so, yeah. Drink it about half hour before you went. Okay. Drove Rochester, I got there early, kind of studying on the car. Plan to do something. I could have went down. Yeah, half hour later, I could lay it on the floor, I took a sleep with it. Them things didn't do.
That's crazy. Crazy. Yeah.
It's almost what?
All the like different accelerators.
Yeah, the big, I don't know. That's a difficult, they ask so many tax questions,
Yeah.
but
You know, they throw a good mix of stuff in there. Taking the practice exams, you know, there's just about everything. So, yeah, just gotta be ready for it.
I think they'll love my car questions. You're gonna get my car questions. Or like, I don't know. Well, it's like,
Well,
for me, it was like, it's like, and after the. Just like, go.
well, I think that's what you gotta. You'll probably get a portion either at the beginning or in the middle, or whatever, where you're gonna like, did I even study this stuff?
Yeah.
And my thought is, you just gotta take it a question at a time, because I think it's almost like they're emotionally trying to destroy you. Then when you get to the ones you should know and do know.
They're trying to throw, yeah, they're trying to throw you off. I know a lot of people, from what I've been reading, they use a lot of, like, obviously on the other tests, they do too, tricky wording and scenarios, yeah, things like that to try and throw you off. I haven't watched this, I haven't watched the 65 video. I've got some other ones for that. Cause I like watching the actual, that like 60-minute exam one, I watch it like driving all the way there, so that works out nice.
What they told us back in the day, 100 years ago, is that depending on how people pass tests, they basically have like 10 questions that are like, hardly anybody gets.
Yeah.
So they had a lot of people pass and they'll give you those first.
All right, here we go.
So they say, just go to the question. Just keep going to questions until you know one, and then go back on those,
Okay.
just because they're trying.
Whatever, do 65 lessons advisory here this week.
I know it.
Yeah, on Tuesday. Thank you.
Good, thank you.
Coffee now, that's
Coffee, there we go.
on meat, that's not good.
Coffee on meat is good?
No, I said. you want
Oh, that.
This
I'm
season.
like, wow, you got a new one. I never heard of that one before. Well, one of my company heroes, Wallace Murphy. All right. Okay. We're gonna jump into the second half. Excuse me. So I'm gonna just show you a couple things if you aren't aware, right? Schwab just raised their minimum account size for RIAs to 2 million. Okay,
Wow.
Yeah,
From 500 to 2 million.
yeah, look at this. Advisors in the program must have 250 million AUM to use Schwab as their custodian. Yeah,
Well, you're almost there.
Glad we didn't stay with Schwab.
yeah, yeah.
Oh,
So that's a little ugly, hey? Okay. Fidelity. Okay, I looked up a couple things to talk about, right? If you want to have an advisor, if you got 50 million, you can have a phone call or a video with somebody as an advisor. If you got 500 or 50,000, excuse me, if you got 500,000, you can actually have one person you get to talk to for 500,000. Okay, yeah. So just think of our clientele. Think of your moms and dads. It's like, who are they going to talk to? Okay. Now, I know that I hear talk about the fees with our managed account program. I talked about this, I don't know, MPI or here not too long ago, but just a quick review for you, okay? So read the purple, okay? So if you want to do a UMA, you need 300 grand, unless you pick a income focused or balanced towards income, then you need 500 grand.
This is through Fidelity?
No, this is, look at the, no.
Edward
Edward Jones,
Oh, okay.
Edward Jones up on top. But let's talk about fees. Oh, their fees are really low, okay? Go ahead and read this. So when we disclose, we called our total program fee. If you're selling SMAs, you're giving them the all-in, that is everything. You're seeing here, the 135 and the 0.05, the 1.4, that does not include any fund expenses. Ours includes fund expenses. Okay? So there's a difference in disclosure. There's been some talk about people wanting us to price like this and not show funds. I like it right now. We're just telling the truth is what we're doing. Okay? Yeah, yeah. So it's interesting, right? So if you weren't aware of that, okay, I pick Edward Jones because in the Midwest, we run around them a lot. I don't know about where y'all are from, but around here, we run into them a lot. Well, if they're saying 1.4, that's not the whole story. Okay. That's like us without all the other expenses added up. Now, notice they also, I can't remember if it was this one or other one because I had all kinds of different things, right? Their fees are like ours used to be on the Freedom Program way back yonder in the Paw Paw Patch. On the first 250, they charge X. And then they give it's 250 or 500. I didn't dig that deep in this. I have that in another module. Anything above that gets a lower, but this pays the full fee. So it keeps laddering up like that. Ours does not work that way. Ours is like an A-share fee structure. So once you get to 250, everything gets a break. You're not paying the higher on the first 250 and then a little lower on the next and a little lower on the next. Everything gets the break. And we can also household together accounts. It's like Meg and I have got Roths, we've got traditionals, we've got non-qualified accounts. They're all linked together. So all of them get the same volume discount fee, not just the biggest ones. So we could open up a $25,000 account and it would get our volume discount fee if it's linked to our accounts. That's cool also with how our managed account system works. Okay, so just a couple of eye openers for you. Okay, now I'm going to apologize in advance. I received phone calls and emails about what we talked about last month. So I'm sorry to kill you, but I'm going to go through a quicker version of what I trained on last month on managed accounts, how we pair them, providing income. We did it on MPI like the following week or something also, but I've got questions. So I took some of the slides out. Okay, I'm gonna go through some of those again, in theory, because apparently I did a bad job. So starting out, we were not using any growth managers in our non-qualified money because of capital gains and taxes. But AGF, David Ward, did research for me and came up with the fact that during this time frame, right, 21 through 25, only 2% of the capital gains on the AGF US large growth were short-term. 98% were long-term. Therefore, I'm now using that in non-qualified as a growth manager. We do not use Dana unconstrained because Dana will tell you not to use it in non-qualified. We do not use Dana unconstrained. I use the heck out of it in qualified money, but not in non-qualified money. So this was an update to how we were doing things. Now, I talked about this earlier. We're going to spend time here right now for a minute. We used to, way out back yonder, use bond funds. We changed that and we went to using 20% stock, 80% bond portfolios as our fixed income manager. I'm changing that again. We changed that again on our October release. We're now using the 40-60 models as our fixed income manager. Okay. Now, thought process. This is how I teach it to a client. Okay. Think of this like a teeter-totter or a seesaw. If this is the rate the Fed charges, and this is a price of a bond, they are directly correlated. Okay. So I try not to use Trump and Biden's name. I try to be very non-political. Okay, because in, half of the country gets lit up or the other half gets lit up, whatever. Okay, I'm not there to discuss politics with them. So what I usually say is, prior to the prior administration, okay, we were in this environment for way too long where there was the Fed was charging almost nothing and bond prices were very high. We were that way probably too long and the economy got a little, I used the Fed as a crutch, if you will. Well, the prior administration did this with interest rates and crushed the bond market. Now, it's going to feather back a little bit, but it's not going to be a fast return. The reason we were using 2080 models and now 4060 models, the stock market is affected by interest rates, but not a direct correlation like bonds. It's affected, but not a direct correlation. So I'm trying to avoid the bad downturn. That's what I'm trying to avoid, okay? So I was going to update this morning. Hypos are down on POL. I couldn't do it, okay? So 831 data, all right? The 1-year return, this is of 831, the aggregate bond index is 3.14%, the Barclays aggregate bond. A straight bond fund we have available in managed accounts is a Sage Sustainable Core Plus bond. Yes, it is both 3.14 because I had to have an error. I kept doing it over and I kept getting the same number. Okay. I was using the Invesco Strategic Focus 2080 model. In qualified money, we have now went to the Franklin Templeton Dynamic Income Moderate model. You can see the 1-year returns. 1 year, folks, doesn't change my mind on anything. The 3-year returns, though, look the same. The 5-year returns look the same. You'll see bonds actually are at a negative over the last 5 years. But what really caught my eye was 2022. Okay. The 40-60 model, Franklin Templeton, actually does better in the good years and did better in a really bad year. Well, let's see. That's not a hard decision then. That's why we made that move. Okay. So you just saw in retail. I said, I'm going to talk about this later. I'm using that concept a little bit similarly on retail with those defensive and that managed income model, because I just don't want to have total bond exposure. Because how we develop portfolios, the bonds are for stability. And we're not really seeing that, okay? And no, I didn't look today. The last time I looked, the 10-year on the Barclays aggregate was 1.8. Okay, and that's terrible. All right, again, I didn't really look deep, but that's terrible. Now, then we went to look at our chart and how we put it together, right? This somehow gets broadcast around to folks. So I've tried to make it easier. I talked to some of our reps. Does this seem easier if I do it this way? So I color coded stuff. Growth managers green, corn and blend purple. So you got Packers and Vikings, and then apparently the Colts are value. I don't know. Okay, never okay. And then I lined them up. These are the ones that we use that we recommend. I lined them up from higher beta to lower beta, so you could kind of get a feel for how volatile are these things. This is a 3, 5, and 10-year average betas is what I'm using. Okay, and if it didn't have a 10-year, I use a 3 and a 5 and averaged it. So that just gives you a flavor. Also, maybe you aren't aware of that some of these are multi-cap, like the Dana All Cap says Dana All Cap. I can figure that one out. But did you know the Putnam US Core is also multi-cap? Did you? So I did that with some of these. That's what the MC to help kind of understand more. Okay, what are they as you're putting this together? Okay. Now, the reason that we normally use the BNY US 100 for qualified or the Invesco Strategic Focus US for non-qualified as a building block and build around it with SMAs is diversification, okay? Each of these portfolios have over 1,000 stocks in them. So they're very diversified, and you got some small, mid, and large that you're opening with to build around. Now, I know we hear lots of talk about SMEs being very tax efficient, and they're way more tax efficient than mutual funds. But the Invesco model hasn't paid a capital gain in the last 5 years. That's very tax efficient. It's paid some moderate dividends. So it's a very tax efficient model, which is why we use that instead of the BNY US 100 for non-qualified. The BNY US 100's got a little better track record. Okay, but if you're going to make 1% more but pay a bunch more taxes, we're going to go this way. I didn't put in today, I took them out, the changes I taught you last month about what they did to the BNY US 100 and to the Dana portfolios. I don't want to spend time there today. Yes.
Was the reason on the Invesco, did he say that's because they're trading ETFs that don't show the gains?
Yeah, they trade ETFs, they trade them in kind. So if they make changes, and also the Invesco ETF portfolio is actively managed. It's not a totally passive portfolio. It is actively managed also, which is cool. Okay, so they do make adjustments throughout the year. Now, and again, some of this I'm apologizing to you, but I received enough questions like, okay, I need to do this again. Okay, so how do we mix and match? How do we design them? When I look at a house, I look at Tim and Crystal's house, I look at their total portfolio. I don't look at Tim's, Crystal's, and joint. I look at the value of everything. And we're going to design the portfolios based upon the whole house. Okay, not just Tim's money, not just Crystal's money. All right. So in aggressive growth models, right, I'm going to usually lead with the Dana Unconstrained. That's normally what I'm going to lead with. Okay. It's got fantastic numbers. Hey, Kurt, have you seen it in the last 60 days or the last few months? Yeah. So you're saying if Jordan only has 20 a couple nights in a row, you're going to bench him? No, I think we'll let him play again tomorrow. Usually when there's a statue in front of the building and you're the statue, usually you get to start as a rule, you know? So yeah, it's been a little bit weaker this year. So look at the track record.
What's it at for the year?
Yeah. I don't know. Yeah, I don't know. So one year doesn't motivate me either way, either one. It's 1 year. It's whatever. Okay. 2 years, 3 years. Okay. We're probably going to change, but a bad year doesn't influence me a lot. Okay. Now, we're going to use a high percentage of growth managers for aggressive growth people because they care less about volatility and more about total return. So we're going to play harder there. I will use some blend and some value, but I'm going to lean more towards getting growth in, okay, before I start adding other ones typically. So this is the chart for aggressive growth. This is 10/10 when it was released. This is last month's release, right? And we've got qualified money and non-qualified money. And these, we just pick out of these. There are no, they're in each section. For example, look at the $1 million section here. They're in order of volatility. Okay? They're in order of volatility. That's how I've got them put in each section. Thought that might be beneficial also. Excuse me. So you just kind of pick whatever you think. These are the ones we use. Meganized money is invested like this. This is how we invest our cash. Okay. So I'm not a guy that says one thing does something else. We do this. We follow this chart. Okay. For growth portfolios, the UMAs are 88% stocks, 12% bonds. That's because I'm using the 40-60 model as the fixed income piece. Okay. All approved by the Home Office. All good. Okay. Same thing on Franklin Income on retail. I got approval from the Home Office. Could I use 50% that and 50% dividend strategy for a 2-fund moderate growth mix? I wanted to know before I sent it out and found out that we're getting rejected. So compliance went through it and said it's good. Okay. So when we use growth models, AGF US large growth is typically our first choice. It's more consistent. I love Putnam US large also, but it's $100,000 minimum. AGF is 50. Okay. So if we look in this, did I miss something? No. Okay. I guess that's later. All right. So this is the growth recommendation chart. Right. And I showed you guys last month the changes they made in the Dana growth portfolio model to improve it by putting the ETF of Dana unconstrained and Dana concentrated dividend into them. Okay. Love that. Again, it's a portfolio. I'm looking at the whole couple. I'm looking at Tim and Crystal. I'm looking at all their money, not just an individual account when we do this. What I mean by that is this. If Tim and Crystal got $700 and $999 in their house, that's what I'm making my choices out of. Okay. Although Tim may have 400 in his and she may have 700 in hers or whatever, or 300 in hers, excuse me. I'm going to kind of build that way a little bit because I want to use more managers. Because the more managers we use, the less volatility we're going to have, in my opinion. Because Putnam doesn't do it the same as Invesco, which doesn't do it the same as Dana, which doesn't do it the same as BNY. They all have their own little bent how they do things. So I'm trying to protect this a little bit. There are always going to be down times. I'm trying to minimize down a little bit, even when I'm being aggressive. For moderate growth, okay, the UMAs are like 76% stocks, 24% bonds. Okay. I've heard people, say like the old 60-40 model is dead. I don't know if I'd argue with that a lot. But this is moderate growth, not 60-40. Okay. Moderate growth. So when we develop moderate growth portfolios, ClearBridge Div strategy is usually my first choice because of its low volatility and consistency. It's a blend manager for equity income, I guess you could call it, but it was only down 7% in 2022, where the S&P was negative 18.1. Well, that was really attractive. Again, we aren't going to lose people if we lag just a little bit on the up. We're going to lose them when they get killed. That's when you're going to lose people. So moderate growth, this is where we have people when they are taking monthly income. This is where we have them, okay? So I want to reduce volatility a bit because they're going to be we're going to be selling every month. So I don't want to have tons of volatility. So we want to have a growth manager in there also and I'm gonna use AGF US large growth as my first choice always. Why? It was only negative 13.4 in 2022 when the large growth index was negative 31.5. It's got great numbers. They're really good. That's a great portfolio. But I don't want to just give up on growth in that portfolio. So if I'm gonna, if I'm gonna use a growth manager, which is my goal, if it's large enough, I can do that. Div Strat's gonna be first choice. Second choice, very well, is gonna be AGF US large growth. Okay, because it's got better numbers, it's got a little more pep in it, but yet it played great defense in 2022. And here's what those portfolios look like. Excuse me. So same concept again, using the whole house assets. Okay. Now, next we're going to talk about providing income. I don't know if this is talked about a lot. And again, I know this is 100% repeat. I took a few slides out, but we're going to talk about providing income. There's lots of talk about using Genter and using the dividend. I have no problem with that. So don't read between the lines. I have no problem with that. But that's never been how we do things. We design everything for total return, not dividends. And I'm going to give you real examples of what happens. Okay. And I feel that ours provides as good or better monthly income to clients, and the portfolio still grows. So, a smile for my son, okay? How I teach people, okay, when I'm meeting with them, right? I draw on my face. This is the economic cycle of the country. Boom, slow down, crash, recovery. It turns every 3 to 5 years on average, okay? So somewhere between 4 and 6 years before you're looking for monthly income, we're going to start paying attention to how aggressive you are. Until then, I want you to be as aggressive as your comfort level will allow you to be. The reason I'm saying 4 to 6 years, okay, is it gives the economic cycle time to do its thing. If I'm meeting with Duncan and Holly and they're a few years from retirement and we're meeting in 2022, I don't want to sell his aggressive. Yeah, you've had a rough year apparently. Okay. Duncan's like 25. Okay. All right.
Really good year.
Yeah. Going really good year. Yeah. Okay. So if I'm meeting with Duncan and Holly, right, and they're going to retire in a few years, I know that because on my annual reviews, I know what their goals are, put it in CRM, right? And we meet in 2022 and the market's down the toilet, we are not going to become more conservative that year. We're going to give the economy time to do its thing. I got 4 to 6 years to play with. I know every 3 to 5 it does this. So we can keep the hammer down for another year or two if we have to. Because we're planning prior to, hey, I'm going to retire tomorrow. Oops, I didn't know that. So that's why I use the 4 to 6 year thing. It gives us time to watch the economy. Maybe he's all aggressive growth. We're 4 to 6 years out. The market's banging away. If he's on track with his fin, I'm going to talk to him about we might want to pull back a notch right now. We could ride another year if you want to, but we might want to pull back right now. I'm going to explain the economic cycle again and what's going to happen. We want to sell aggressive stuff when it's high. And he's going to be involved in the decision process. I might bring him down to growth right now. I might bring him down to moderate growth right now. There's no cookie cutter here. It's the client involvement also. I'm just providing the knowledge so he can help be involved. I'm not going like, here's what you got to do. Because if you shoot him, it only makes him mad. Okay. I'm not gonna instruct him or tell him. I'm helping him with his money. I'm not instructing him with his money. So that's the concept there. Now, we use this chart. We've been using this, I think it came out in 2006 or something. I don't know, but we've been using this chart for a long 2008, I don't remember. A long time. Okay. This is a chart that shows based on what percentage of your money on the left side you draw out, how long your money will last, how many years. Now, 2 caveats in here. This is a study done from 1926 through 2006. So it's an 80-year track record. I feel pretty comfortable with that. Okay. It also assumes the client takes a 3% pay raise every year in retirement. I have 0 clients that take a pay raise every year in retirement. 0. Sometimes people want a little extra money. Sometimes we might bump it up a little bit. Nobody does it every year. Therefore, this also assumes a 50% stock, 50% bond portfolio. We're 76-24. Okay. So we're not going to be there. Our old model, I think, was 72-28. Does that sound right, Isaac? I think using the 2080 model. Okay, right in there. So we're not going to be 50-50. So this is a conservative portfolio. If the client doesn't take a pay raise every year, it's a conservative portfolio. Because if you aren't taking more money out every year, your money's going to last longer. So I tell them that, but I want to use these numbers. Okay. Kelly and Mark will never go. I'm so frustrated with Kurt. We're 82 and we've got too much money left. Oh, he makes me so mad. Said no one ever. Okay. But if I plan too aggressively and we run out of money, that's a bad strategy. So I still want to use, so our target is 4 to 5% for clients. That's our target. Okay. So we'll look at some actual examples. Okay. I had Audra pull up. Does it sound weird when I said, should I say mom? Okay. I had Audra pull up. She's my mom, so I'm really explaining it to you since I'm older. And it's pretty weird. Okay. I had her pull up some clients for me. I wanted to go back further, but with a switch from Freedom to TD and then to Pershing, it's like, okay. Because I've had clients taking money out of Freedom portfolios for a long time too, but I couldn't go deeper. So this client on 1/1/19 had $504,000. We were taking 5% off. So you can see over on the right, as of 9/30/25, it had grown to $676,000. They had taken out $179,710. So they'd averaged a 5.3% because they've taken a chunk out a couple times. So the portfolio has grown by 171 grand and provided them 179 grand of income. This was using the 2080 model. It used to be Sage Multi-Asset for fixed income. It used to be the Sage Multi-Asset Income. Then it went to Invesco 2080. So that all these numbers are that. Now I've switched to the Franklin model, and we've talked about why. So 4 or 5% doesn't seem like it's an issue. And yeah, we've had some downturns. It's taken some hits. You can see that. But much less hit than the market, which is the objective. Okay. Second client I had her pull. Again, guys, the goal is 4 or 5%. It's not just always 5. Hey, you guys should take this much out. No, we're going to talk about how much they need, using their fin and the mobile F&A, how much they need. But I'm going to coach them 4 to 5. That's where we want to go. We don't really want to go higher. Okay. Could they go higher? Sure. But if they're going to, I'm every year at our annual review, I'm using this chart and reminding them. If you're taking out 7%, I'm reminding you, Tim and Crystal, based on what you're doing, you're going to need to apply your money in about 14 years. So if they're taking out more than that, that's an every year review. In my CRM, I reminded them of that every year. So Tim doesn't go back and go, hey, I'm running out of money. What's your problem? Well, Tim, we talked about it in 25 and 24 and 23 and 22. And, I want to make sure that I don't want him to be blind. Okay. If he wants to take out 7, it's his money. I'm not going to go, no, I ain't going to allow it. I just want him to know what he's getting into. And if he calls the ball, he's the client, but I'm documenting in my notes what we're talking about. Okay. So this one started at 902,000. All these were taking out 5%. Many of them I take out less, but I picked some I'm taking out 5 because I go, let's use that. So 45,000 a year, right? At the end of last year, right? You can see, or I'm sorry, at the 9/30 of 25, it was $1,094,000. They've taken out 441,000. We've taken some chunks out of here. Their monthly isn't higher than the 45, but they've taken some chunks out sometimes. So they've averaged 65,000 a year, or 7.2% of the original amount. It's still grown by 182 grand. So they're still okay at 5%. Okay. I'm going to caution them if they want to be taking out 7 all the time. But hey, I needed to buy this. I needed to buy that. Okay. And then the last one that I have, I did 3 of them. Audra did 3 of them. I put them together. Okay. This client in 1/1/19 had $1.3 million. We had a 5% withdrawal rate. It's grown to $1.9 million. Okay. We've taken out, he's actually taken out less some years because they don't need the money. Okay. So he's averaged about 4.6 from the starting value is what they've taken out. It's grown by $500,000. So I feel very confident in how we're recommending and how we're doing it based upon history. And again, there's a lot more clients like that. Okay, our AUM in manage is 134 million personal. There's lots of clients taking money out every month. But this what I just showed you is how we do it, and it's working for clients. Okay. So now my goal was to leave time for questions and answers. We're going to. I always give myself the kiss of death when I say that. Okay. So we're going to expedite through a few things. I'll talk about overcoming objections for a minute, okay? And I know you've never seen this before if you've been in anything we do, okay? But it's important for you to remember 55% of the message the prospect or client receives from you is body language. 38% is tone of voice, only 7 is the words. So when I go, I want you to memorize the words, you go, well, Kurt, that's stupid because it's only 7%. It sounds right at first, but it's actually smart to memorize. Because then your total focus is body language and tone of voice. It's not what am I supposed to say? Because all of us have been where we're stumped and we're going like, trying to think what I'm going to say next. You don't have really good body language and tone of voice when you're doing that because you're still nervous about what you're supposed to say next. So if you memorize what you're supposed to say, now it's a conversation when you overcome objections with people. Okay? So let's take a minute. Let's review through this one. So Danny, I've heard it's better to have a low fee index fund than to pay somebody like you.
Can I ask you a question?
Sure. Yeah.
Do you realize that if you choose the investment in index funds, that you're guaranteed to never beat the market?
What do you mean?
Because when you invest in index funds, even though your fees are low and the fees reduce the return on that amount, Kurt, would you rather invest in actively managed funds and have a chance to beat the market, or invest in index funds and never have a chance to beat the market?
Well, I'd like to have a chance to beat the market if I could.
Great, let's get started.
Okay, right, very good. So hey, Braden, I've heard that low fee index funds are the way to go. I don't know why you're telling me this stuff you're saying.
Hey Kurt, may I ask you a question?
Sure.
You realize that if you choose to invest in index funds, you're guaranteed to never beat the market?
Why is that?
Well, because when you invest in index funds, even though the fees are low, the fees reduce the return by that amount. Kurt, would you rather invest in actively managed funds that have a chance to beat the market, or invest in index funds and never have a chance to beat the market?
I'd like to have a chance to beat the market if I could.
Well, great. Let's get started.
Good job. Okay, good hand gestures. Okay. So learning what to say, objections are your friend. If people never give you objections, they probably don't close either. Objections are your friend. You love objections because it tells you what's keeping them from going forward. So I want you to give me objections if you got them so we can overcome them so we can move forward. Now, what'll happen at some point, if when you're seasoned and you've been doing this a long time, I get objections how often?
Almost never.
Yeah, I just don't get them. Because either my clients are stupid, or I don't know, no. I exude confidence, and I've built a track record with them where they don't question it because I've told them the truth. But I continually back up the truth with charts and stuff like that. So it's fun when you get to that point, okay? So let's go to wrap up here, and then we'll do some Q&A, right? I know I beat this to death also, all right? But providing great customer service is gargantuan. We will not use names, but you heard a phone call on the way home from Wyoming, okay? Somebody that just hit a giant income milestone that's chose to copy how we do stuff for some reason. They were like giddy. We're going to put a pool wing on our house. You know, you told us what would happen. And people call us every week with money. We just can't believe it. Okay. This isn't, it's just, I talk about it. Other people do it, I'm sure better. If you provide great client service, the mass of money that's moving is out of control right now. And it's growing. It's 124 trillion in the next 25 years. It's insane. If people like and trust you, they're going to call you when they have money. I promise you. They're going to call you when they have money. Give them great customer service, and they trust you and like you. You build a reputation with them over time. They tell other people about you. And the other people just show up, and there's not a lot of presentation. They just trust you. You can't do anything to screw that up, though. You got to be, you got to be straight with people always. But having that lifestyle where people just call you with money every week is pretty fun. Okay? It's pretty fun. Now, to do that, you've got to have staff. Okay? I see too many RVPs that do everything themselves. I'm going to take an old Art Williams saying here. Dumb, dumb, dumb. Okay, if you listen to old Art Williams, you've heard him say that, okay? Hire people that are better than you at administrative things to do administrative things, okay? That's another common question I get asked, right? Is how do we do stuff? I mean, 2 days a week and we're doing this kind of business and that kind of stuff because I don't do anything administrative. I am terrible at it, and that's giving me a compliment. Your mother would agree, okay? I'm terrible at it. I don't want to be good at it. Our staff is better than me. I want them to do it. So a common thing, if I ask people, how much time do you spend administrative every day? 2 to 4 hours is a normal response. And people don't have a staff because they say they can't afford it. If you're spending 2 to 4 hours a day on administrative, if somebody else did that, you can do 2 to 4 more appointments per day, 10 to 20 more appointments per week. Can you really convince yourself you can't make enough money to pay a staff person if you do 10, 20 more appointments a week? I don't think you can. And also what happens is this, since I am terrible at that, it drains my battery. It just, okay. So I'm using energy that I should have to talk with clients and do a good job, burning my butt out due to administrative stuff that I'm terrible at. Why not pay somebody else to do that and do what I'm good at? All of you are good at something, right? Let other people do that stuff so you can focus on the client. Here's our updated client information sheet. Audra just updated it. Okay. Our style is, I want to have all the apps pre-done before I meet with the client. So this is just an information gathering sheet. If it's during hours, because I'm in later on Tuesdays and Thursdays because I'm only in twice, so I'll do, a 5 o'clock appointment or whatever. Our office closes at 4. So if it's after hours and I'm talking to Denny and Kate and they want to become a client, I'm going to say, Denny and Kate, tomorrow I'm going to have Audra call you guys and gather some basic information. She'll pre-fill all your applications for you, and then she'll schedule time for us to get back together again. What's a good number to call and a good time tomorrow? And then I'll tell Audra, she'll call and she'll ask all these questions. And then she'll do the application. And then I will meet with the client. I'll do the IRA assembler and the proposal. I'm considering handing that off to her, but I haven't got there yet. Okay? So she just puts in a fake IRA assembler number and just grabs whatever the first proposal that pops up, she just puts that in the app so she can get past it. And then I go in knowing I've got to fix the IRA assembler and the proposal. So now many of our reps use this also information sheet to gather information from the client because it can be cumbersome to fill out the app in front of the client. If it was me, it wouldn't be cumbersome, it would be painful. Because I couldn't do it. Hey, I want you to know I figured out how to change a pack on a managed account yesterday. I am like,
I'm not calling you a liar.
I'm
not calling you a liar, but.
That's a piece of cake.
The truth.
Audra is probably gonna be asking me for help with administrative stuff now, okay?
Yeah.
Okay, so this is how, so,
I'll give a PSA on this.
go ahead.
So for anybody that doesn't know, when you set up accounts for clients, you know how we reserve a user ID for them in the application? When they go to log in the first time, do you guys know what the password is? Do you know how to help them log in? It's the first 2 digits of the security word, the first 2 letters, and their 6-digit date of birth.
That is always.
That's always their password for the first time they log in.
On the managed accounts.
On managed accounts, when you set up a password, it took me a long time to figure this out.
Those are initial.
Yeah, say it out loud again.
When you put in the user ID and the security word on the managed account application, that actually sets up a login for them. Their login is the first 2 letters of the security word and then a 6-digit date of birth. So I always use mother's maiden name for security word because it's easy for people to remember. If I ask my mom, it'd be Peterson. So it'd be PE and then her 6-digit date of birth, 2 day, 2 month, 2 year. Once they log in with that, it'll then prompt them to change the password to whatever they want it to be.
Oh.
But I had so many phone calls with the budget diamond desk to reset people's password. Actually, the
And you
client
can
line.
find
I
the
mean,
user ID.
the online ID is
Yeah.
one thing, but the password's another thing.
Correct. You can't see the password once you log in. Once you set it up.
All right, perfect.
Just thought I'd let people know that.
All right. Key times to call your clients. When the market is ugly, especially, okay? Because you know if you got nervous Norbert or nervous Nelly as a client, call them, okay? Call them. So if Donna's looking at her account and she's having a stroke, and I call her, hey, Donna, actually Audra would call her, but if I would call her and go, hey, Donna, hey, this is Kurt. Hey, I'm just calling. I was just looking at your account. Everything seems like it's in pretty good shape right now. You're weathering this very well, but I just want to call to see, do you have any questions? How are you doing? And she's going, oh, my advisor's looking at my money. I think I'm going to make it. Okay. So let's go to Q&A. All right. By golly, we did it. We left a little time for Q&A already. Okay. So let's, Donna.
Goal or utopia for a return on the fixed income part? Like, is it 4%, 5%, 6%?
The moderate growth or the fixed income?
Yeah,
Don't really have one. I look at the total return of the portfolio. Yeah. Yeah.
Threshold would be like, I couldn't tolerate less.
I guess that's what I'm trying to say.
For the fixed income?
Yeah.
Well, right now with anything in bonds, it's going to be not impossible, nearly impossible to find a 4% 10-year number. Yeah. Oh, the moderate growth portfolio, 5-6 comfortably. Okay. And I say that because I just showed you numbers where we're taking out 5 and they're grown. But I don't want to go, hey, you're going to get 6.5, 7. And then they get 5.9 and they go, hey, you didn't tell me the truth. Okay. So under promise, over deliver. Under promise, over deliver. Do we have any other questions? Go ahead.
Kurt, going back to target funds.
Yep.
So I found out the importance of seeing 401k statements, employer plans. just because most people don't realize. We're on top of compliance and that's always a touchy issue about.
Yep.
And why. How do you handle this?
Okay.
When you're seeing.
You can't tell them exactly what to do. And I would teach them why target funds are bad. You know, and in our portfolio, I'm gonna have you, you know, you're gonna be in this type of fund and this type of fund and this type of fund with us. Okay? I don't broker your accounts, I can't really tell you what to do. But you're gonna be in growth funds and, you know, you're gonna be in large cap growth funds and large cap value funds with us or whatever it's gonna be. But you can't tell them on their statement what they're supposed to do.
Do you see that more often where I'm seeing a lot where everybody's getting slid to fixed funds or to.
Yeah, and that's devastating to them,
Yes.
devastating. Yeah, because they don't know, I mean, they don't, just like you and I didn't know, by the way. They don't know what they're in, I'm in the fund that the guy sits beside me has lunches and it's gotta be good. I don't know, I mean, they don't know. So it's not an insult to them, it's just they don't know. Okay. I don't know how Donna made that cake. Not an insult to, I just don't know. I don't know that.
Client who, this is my husband, right? His 401k plan, we reallocated it the next year and it's swept back.
Oh, so you gotta see if there's a rebalance feature on it. Yeah, that's, oh, that's really fun. Yeah. Yeah. Good catch. Do we have any other questions we want to ask?
Yes, I want to ask you about profit taking in a good market. Not selling all your things or something, but if you see that your investment's been beating the S&P 500 for say 5 years or more or something like that, you maybe want to take a little bit off the table.
What is the objective of the account, David?
Well, the objective would be to get some gains and maybe client needs some extra income or something, not a lot, but just, enough to because, I guess I've had some investments that are up over like 500%. And then, I've held on to them and they've dropped down to like 80% or something like that. And, I kind of wish that I not sold the whole thing, but taken a little bit off at the time.
So if the client doesn't need money, I would diversify that portfolio farther. If they need money, you take it out because they need money. Otherwise, I would spread it around farther, and that would take some of the dollars out of that one that's really, really performed well.
Yeah.
Because
Okay.
I would be thinking asset allocation, all my money shouldn't be in one fund, asset allocation, and hey, this one's getting too heavy. I need to get some out of there and get it into something else to diversify the portfolio more. That would be my thought process.
All right. Thank you.
Do you have any other questions?
Kurt, good morning. I have a question. I'm starting to do managed accounts and SMAs, and I have several clients with large amounts of money in non-qualified accounts and mutual funds. And considering moving them into managed would require that they pay taxes on all the appreciation. When does it make sense to do that? When does it not?
Okay, so we'd look at their tax table. We're not gonna be the tax accountant to give advice on how much they're gonna pay, but we can get an idea where they're at as far as what long-term and short-term capital gains rates are gonna be, okay? If they let the portfolio stay like it is, the tax pain is only gonna get worse over time, okay? So it's a conversation with them at some, here's the managed account and here's why we want to use the ETFs and the SMAs. And when they see that, okay, great. So at some point in time, we're gonna have to bite the bullet a little bit. Right now, there's $400,000 in the account and there's $150,000 of gains, right? Which is, I'm very happy you've made good money. If we let that set, right, in another 5 or 10 years, it's gonna be 800,000 with 500,000 of gains. And the pain could be worse then. So do we just delay this and deal with it at a later time and pay more taxes? Or do we absorb it now, cut our losses and be done, and then have the portfolio grow and be tax friendlier in the future? What is your thought process, Mr. and Mrs. Client? And then maybe even you do some, it's a great time right now because we're in November. Maybe you do some now and some in January, 2 different tax years.
Got it.
But we can't give the advice on what you're gonna pay in taxes and anything, right? We can, they have to, their tax person would tell them that, not us. But I've had some where we did that and it was just like, let's just eat it and get it done because it's only gonna get worse as the portfolio keeps growing.
Perfect. I appreciate it. Thank you.
We got time for another question. I'm not sure, Don, your screen goes purple and green and purple and green. It's like psychedelic, dude. Okay.
I have a question, Angel, again.
Yes, ma'am.
All right, when you did the withdrawal, 4 to 5 was the goal. How are you doing the chart? Where do you get that chart from to give you the data as to how long it will last?
That was a chart that was in an old brochure. It was in an old brochure. It was actually I think it was a MetLife or Bright House brochure. I think Donna's getting up to look at it to get it right now.
Do we have anything in Lifetime that do we have any program in Lifetime? Any clicks that we can go on in order to see how that really looks in real time for a client? Client has $400,000, they want to start withdrawing money. Do we have anything there that can give us the example?
Okay. I don't know if I'm clearly understanding the question. I'm sorry.
Okay. When we have a client that wants to know, hey, can I retire yet? That question. How long is my money going to last me?
Right.
Where is the tools, or do we know of any tools that can tell us the answer to that question or help guide us so that we can guide the client how long their money is going to last if they take out that 4 to 5%?
Right. I am handicapped because I've been using this chart for so long, Angel. That's all I use. Okay. Did I just lose Angel?
Oh, I'm here.
Okay. You moved on my screen. I couldn't tell where you were. Okay. So I know that you get my daily Bible verse, right?
Absolutely.
If you send me an email, I'll send you that chart.
Okay.
Okay, that one that I use. It's from a brochure from one of the annuity companies, actually. All right,
Great,
we're out of
thank you.
time, but I'll answer another question if we have it. These are the dates coming up. So anybody have anything else?
We have 2 Januaries on there. Does that mean that the no boot camp is on February?
Ha! Thank you. That no boot camp was on February. Thank you so much, Mark and Kelly. Yeah. So just a second here. Audra didn't make this. I did. You can see.
Administrator.
She's not working 80 hours a week.
Okay. Thank you. Thank you. Okay. Anything else, gang? I don't want to hold you over time. Yeah. All right. I hope there was some value for you today. Have a great Thanksgiving. I'll see you next month. Bye. Woo!
Thank you so much. That was amazing.
Where's my mouse at? There it is.
Mahalo, Kurt.
Thank you, Kurt.
Thank you. Appreciate you.
Bye. Thank you, guys.
Well, what's in that?